But let me, before I hand off to Ryan, I talk about this often on the radio and with client meetings. We all talk about it. If you look at historical returns, you can tell a lot, but you need to understand what you're looking at when you look at historical returns. We are coming off a 30-year bond bull market. Since the early 80s, interest rates have come down. Interest rates back on September 30th, 1981 was almost 16% as far as the 10-year Treasury yield. And now today we know as of today, we're at about 1.8%. That means yields come down. The price goes up. So anybody who owned bonds over that time period when interest rates go up, you're going to have, and this goes, I'm sorry, over here, falling rates. When you have the returns, and this is corporate bonds from 1982 through 2014, almost a 10% return. The S&P was almost 12%. Inflation, 3%. Your annual real return, which is your actual return less inflation, in bonds, 6.8, in stocks, 8.6. And we go over this more than ever lately, because a lot of people want to have less risk in their portfolio, and the first thing they want to do is add bonds to their portfolio. And when we look at past performances over the last 30 years especially, why wouldn't you want bonds in your portfolio? Less risk, almost identical return. Well, the reason why bonds did so well is because interest rates dropped and the price went up. When you look at this chart over here, what happens when it's the reverse? This is a period of 1958 through 1981. Corporate bonds averaged 3%, the S&P 8.6. Inflation, believe it or not, back then was 5%. Today we're at, what's the inflation rate today, the latest number?
1.9.
Yeah, and 3% even seems high, but we know inflation will rear its ugly head soon enough. But back then it was 5%. So your real return in bonds was 2%. Your real return in the S&P was about 3.5%. The point I'm making here is one of the reasons why we're comfortable with stocks, and we're not really, for those of you that have had any conversations with us recently, bonds is the one area that we just scratch our head, because last year the best return in all investments was the long bond. Well, interest rates were supposed to start going up 2 years ago, last year, this year. We know interest rates are going to go up, and as I said at the beginning of the presentation, it's just a matter of time. We just don't know when interest rates will go up, which is why on the fixed income side of your portfolio, normal, let's say, growth and income portfolios is 60-40 mix, 60% equities, 40% bonds, alternative assets, which we consider preferred stocks, real estate investment trusts, master limited partnerships, and cash. Well, we have more of those alternative assets in cash than we do bonds, because we're just not sure what's going to happen. We don't want to tie up any of our clients' money. 10 years, which is the safest money in the world, at 1.8%. We know interest rates will go up. Can you imagine when interest rates were 1.3, 1.4%, tying up your money for 10 years, and then interest rates at the beginning of last year went all the way up to 3%? You'd be stuck with that 1.4%. Who would want to buy that bond from you? They can buy a new bond at 3%. Here we are all the way back down to 1.8%. So this is the area of the portfolios that we're being very patient with, and we think that there's going to be more risk coming down the pike in bonds than not, depending on how you buy bonds.
So this just gets into a little bit of how we strategize in terms of building the fixed income alternative asset side of the portfolio. So no matter if you're in the growth, conservative, from a fixed income perspective, this is really what we're thinking about and how we want to try to build that side of the portfolio. As you can see, we kind of start with our core holdings, kind of make up a big portion of it. And right now, due to where rates are and what the expectation is with potential rise in rates, we really want to be short-term and low duration. Now, we're trying to protect ourselves from a rise in rates, which, if we were going longer term, even intermediate term, as my father alluded to, that 10-year Treasury as rates start to go up, if you're stuck with a 1.7% rate and they go up to 3, that's not going to look as good in your portfolio. So we're focusing on really short-term bonds that hopefully will not be as effective as much in a rising rate environment. Floating rate funds, which could benefit a little bit from a rise in interest rates, as well as core and strategic bond funds where maybe a money manager has a little bit more leeway to get in and out of certain positions. The fixed income market is much larger than the equity market and much more inefficient. So at times, it does pay to have an active manager be on top of these things and find the opportunities in the bond market. From there, we go into our core complements. So what we're looking for is, we want to reduce some of that correlation to the core elements of the fixed income portfolio. International bonds, as you saw from the presentation, in the U.S., we're at, hopefully we think towards the bottom of where interest rates are. We may be moving into a rising interest rate environment. Europe is just the opposite. They're still coming down. They're putting quantitative easing to work, which we've done for the last number of years. So they're coming down with lower interest rates, appreciation in the price of bonds. So it's not closely correlated to some of our core holdings. We also have in there some preferred equities, which will give us great yield, but aren't, again, as closely correlated as a short-term bond or a core bond fund. And then finally, at the peak of the pyramid is our extended sectors. And with these, we're looking to gain income as well as total return. Now, we use our alternatives in this space. MLPs, master limited partnerships, they're essentially collecting a toll throughout the U.S. of energy production. So, they're not as closely tied into the drop in oil prices because you still have to transport the oil. And REITs, real estate investment trust. Now, the beauty of how those two elements are structured is that they have to distribute their income by law because of the structure of those funds. So with that, we get income, but we also get price appreciation. That's where we like that total return element of the portfolio. And finally, we may not be getting a ton of yield in some of our core elements, but there's a reason why. The dotted line at the top is where the treasury curve, the yield curve was in 2013. The lower line, the dark or the light blue but solid line, is where we're at December 31st, 2014. As you can see, that yield curve has flattened out a little bit. And what that means is you're taking on a lot more risk pushing out the longevity of those bonds with a much lower return and much lower yield, which is on the y-axis on the left. So, you're taking on more risk, not as much return for that risk. So we're really focusing on more short-term capital preservation, but, a core element of our fixed income portfolios.